Hello and welcome to the Hotel Investors Marketplace produced by Hotel Brokers International. I'm Charlie Fritsch, President of HBI. The Hotel Investors Marketplace is designed to provide the most current information in franchising, lending, and valuation, as well as provide an opportunity to preview recently listed hotels. While everyone gets signed in and comfortable, we'll highlight a few HBI member listings on the screen. And I'll take this opportunity to share a few items. Hotel Brokers International is the leading hotel sales organization with more than 50 hotel brokerage specialists. Founded in 1959, the organization's broker professionals have successfully negotiated more than 10,000 hotel real estate transactions and annually account for 48% of all mid-market and economy hotel sales in the United States. Visit HBI on the web at www.hbihotels.com. If at any time during the webcast you have a question, just click on the Ask a Question button from the gray bar located at the top of the webcast player. Type in your question and submit it. We'll try to answer as many as our time allows. Please let us know how we're doing. Rate today's webcast by clicking on Rate, which is found in the gray bar located at the top of the webcast player. Later today, this webcast will be posted to the HBI website at www.hbihotels.com for on-demand viewing. And I'd like to now welcome our panelists for today's discussion. Laurie Ivy is a Senior Vice President of Marketing for PMC Commercial Trust, and Joe McCann is President of Optimum Hotel Brokerage. Laurie and Joe, welcome.
Thank you.
Thank you.
Before we get started, I'd like to give each of you a chance to take a minute and briefly tell us about your professional backgrounds, any recent highlights, and basically what you each do at PMC Commercial Trust, Laurie, and Joe at Optimum Hotel Brokerage, and your involvement in the hotel industry. Laurie, you want to start?
Sure. I'm with PMC Commercial Trust, and we're a nationwide direct lender, and we've been specializing in the hospitality industry for over 20 years, and that's really our focus, although we finance other businesses as well. And I have been with PMC for almost 20 years myself, and starting out in the underwriting function and now head up the sales and originations team. And we are actively seeking more hotel loans and wanted to serve HBI clients.
Great. Thank you. And Joe, can you give us a little background on yourself, please?
I'm Joe McCann. I'm president of Optimum Hotel Brokerage. We're an HBI member broker in the Northeast. We're licensed in 6 states, Maryland through Massachusetts. We've been in business for 10 years and have been a member of HBI all those years. And I'm the past president of HBI. I was Charlie's predecessor, so he had the pleasure of cleaning up any of the things I left behind from my last tenure. I'm actually calling from the road. As a broker, it's a good day. I just got a listing, and I'm making this call from an undisclosed location in a northeast city. So I can't really divulge it yet. So I'm the Dick Cheney of hotel brokerage. I'm calling in from an undisclosed location, but happy to be here.
Good. Well, thanks. Welcome, and I'm sure we'll hear more about that listing in the future and see it on hbihotels.com.
Coming to a HBI website near you.
Near you, right. Good. And I know, Laurie and Joe, you've both been involved very intimately with the hotel industry for quite a number of years. And I think both of you, Laurie in lending to hotels and Joe in brokering, get the opportunity to review lots of hotel financial statements and Smith Travel Research reports and see what those hotels are doing in various markets around the country. And our task today is basically to talk about what we're expecting for next year, 2013, coming up quickly on us. And so I'd kind of like to look at that relative to the hotel industry in three different aspects. One is in terms of hotel operating performance. Secondly, in terms of transactions, hotel sale transactions. And thirdly, in terms of financing for hotels and what we might see in the way of changes. Why don't we start with hotel operating performance? And Laurie and Joe, again, you see financial statements and from various hotels around the country. What are you seeing in terms of operating performance variance by location in terms of major markets or smaller markets or sub-markets around the country? Is there any obvious points that you've seen that would give you an indication for how things might continue to be moving next year? Joe, you want to go ahead and start with that?
Okay, I'll start, and I can't speak for every market, but the ones I work in, and Charlie works in those markets, some of those markets too, so maybe you can share some your thoughts on those too as a broker, Charlie. In general, I've seen improved operating performance, and generally have more happier and more relieved types of owners as we crawl out of the doldrums, and I've seen some pretty good numbers in some decent markets, and so I think the recovery is there. In a number of markets, we still aren't where we were in 2008. Mainly, like in the markets I work in, mainly New Jersey was down. Like as of 2 months ago, say New Jersey was still down about 8% of where it was as a state, say in 2008. Now since Sandy,
that's a big impact.
So no one really knows yet. I'm very curious how Smith Travel is going to come out with that, because a lot of inventory was lost. Some of that inventory was seasonal anyway and closed. And the remaining hotels in New Jersey have been full pretty much for about a month, with crews and FEMA and displaced residents. So New Jersey is going to end the year I think very strong, but it's in Atlantic City is still not good. And the recovery there in some of the south part of New Jersey is questionable. But as a state, New Jersey's come back. We have to kind of see where the inventory ends up at the end of the year and see what rooms are out of order and out of service. But in general, I think things are looking very strong. Western Pennsylvania strong with gas and drilling. Pittsburgh, Philadelphia is still down a little bit from 2008, but coming back, just good progressive improvement in like Eastern Pennsylvania and Philadelphia. Connecticut's still a little soft. So Connecticut's probably still about 8% or so, 10% down from where I think numbers were in 2008, as well as some markets in upstate New York. So the recovery, I think, has been a little slower in those types of markets. Further out, and I'm sorry. But overall, I'm very optimistic about this year. I think, and as Laurie may agree with, I think lending is coming back, and in other areas of commercial real estate, some lending is frothy at this point, but it hasn't come to hotels yet. And I think 2013 will be the year that operational performance meets better availability of finance that will be be a great year for buyers, sellers, and brokers and lenders and operators. What do you agree with some of those observations, Charlie?
Yeah, I see. We see there is a lot of variation still in hotel performance, bigger markets, smaller markets, and it's really all about the local demand generators. And Joe, you mentioned in some of the western, we both deal with areas in Pennsylvania where they've seen tremendous benefit from the natural gas exploration, and that continues. And it's also spreading west into Ohio, and there are actually, as I understand, 35 states in the U.S. have some natural gas exploration right now. So that's having an impact in some areas in a big way, other areas not so much. And so we continue to see a lot of differences. The bigger cities, most of them are doing well and continue to recover in RevPAR. And I think we'll continue to see that in 2013, barring any catastrophes or unexpected events. And so, yeah, it's really about the local market and the demand generators happening there, but overall continued improvement. Laurie, as you're reviewing financial statements and around the country and seeing hotel performance, does it look like the positive trend is continuing for the most part?
Yes, I think it is. I agree with what you said that it does vary by markets, but when we're looking at the financial statements of people in our business, they are generally continuing to improve. And of course, there are some markets that aren't or that are still struggling, and so you can't really generalize. It doesn't help those markets, but for the most part, we are seeing improved performance, increasing revenues compared to the prior year in most places. So that is encouraging.
Good. Laurie, are you seeing loan applications increase at all, or just general activity? Your interest in deals with PMC? What has the deal flow been, say, in the past year?
It has increased over last year, and we expect it to increase again at the number of deals that we fund next year. So that's positive, in that we're wanting to lend more money, and we are seeing more increased activity, where people had been maybe waiting on the sidelines a bit and are feeling more positive to get back into the market or to maybe stay in the market and increase their presence, that they don't need to retain so much capital in reserve for the properties that they already have, but they can go ahead and invest in a new property as well. And
Laurie, is there any pattern as far, are you financing more in urban markets, suburban, resort, highway, or is it fairly well spread across?
Well, with our loan size going up to $5 million, it's not in the major urban markets. It's more in the suburban areas and highway markets. Mm-hmm. We're providing financing.
Yeah. And PMC Commercial Trust is doing SBA 7A loans. And are you doing many conventionals, or is it mostly all 7A?
I would say it's about 75% SBA 7A and 25% conventional right now.
Mm-hmm. And what do you expect that to continue next year? Do you see any changes in your lending?
Yeah, I would expect that with us to continue and perhaps, increase the percentage of conventional a little bit as well.
Yeah.
I would like to ask a question to Laurie. I mean, do you see, has PMC mapped out where they think interest rates are going to be for 2013, what their best guess might be as far as where they compared to today? The same, higher?
Well, we are seeing more competition now. Last year and in early 2012, if we approved a loan, we generally weren't competing with anyone to get that business. We are seeing more competition on our loan approvals now, and we are seeing rates go down a little bit. So I think that should be encouraging for buyers. It seems like the interest rate should remain stable for the next year, and if hospitality is having better operating performance and viewed a little more favorably among more lenders, then that should help the interest rate situation as well.
Mm-hmm.
And the transactions, we've just had a couple of closings, and one was an SBA 7A loan at $5 million with an $800,000 conventional loan along with that in pari passu structure. So the lender actually loaned $5.8 million. Laurie, is PMC doing any of that to try to extend the dollar amount over the SBA 7A loan limit?
We haven't done that yet, but it might be something that we would consider for the right deal.
Mm-hmm.
We're wanting to increase our loan volume and increase our loan size. So, we're looking into different options when that makes sense. What we can do to get more money out, into good loans.
Yeah. And to sort of wrap up hotel operating performance for next year, Joe and Laurie, are you seeing variations by brand or chain scale, higher brands? What brands are you seeing that are performing the best out there?
Well, I mean, I think that the standard perception would be, select service and Hilton, Marriott, IHG brands in those categories are still strong. Although I've seen a few of those that were maybe opened in 2007 or 8 that had some structural trouble in terms of finance and the way the market turned out. I would say those are the strongest performers, and they generally are for a lot of hotel investors. I think some of the weaker performers I've seen are, tertiary economy hotels, where those are the types of deals where, the banks take them over and will sell the note or sell them as an REO. Although we sold a Hampton a couple of years ago under that basis too, that was actually performing okay. And it's doing much better now.
Yeah.
I would say the toughest thing right now in the category is what used to be, mid-scale with food and beverage. And I won't mention brands because they can change. But in that category, I mean, those are still probably struggling a little bit because of rate, occupancy, the contribution of food and beverage and expenses and challenging operating and market environment. So I'd say those are the toughest deals. I think those have been hurt from a valuation standpoint the most in that category. They're still operating but it's hard for them to get their NOI up as quickly and rebound as quickly as, a well-located Fairfield Inn or a Hampton or a Holiday Inn Express. So those are still challenging deals. But then At the same time, their values are down. I think there's still a lot of opportunities in that segment when they're well located and well managed, especially in your meeting group and food and beverage business.
Yeah, I think it does take a certain type of operator, and certainly from a hotel transactions perspective, I think we see it. There are fewer buyers for a full-service hotel, but I think a full-service hotel does have the opportunity to kind of have longer staying power in the market if it is indeed managed well, renovated and updated, and in the right market, they can do well. So I think, it's all about fitting the right brand to the location and the product, and updating the product and making sure they're, from a hotel owner's perspective, making use of every single resource that the brand provides, whatever that brand is, can maximize operating performance. So in terms of transactions, Laurie and Joe, in terms of 2012 to 2013, do you think we'll see more transactions, same, or fewer?
I feel like it's going to be, relatively the same, and maybe up a little bit. But I don't know if there's a big change coming. It seems like some types of investors are getting more active, and others have been pulling back a little bit lately. So I would expect a slightly increased volume of transactions next year. What are you guys seeing?
Excuse me. I agree with Laurie, although maybe it's a little bit of broker's optimism, but I see things a little more positive, and I'd say accelerating through the year. I mean, we've had 3 rough years. I think from a political and economic standpoint, I think we've kind of turned a corner and have some certainty in the market, and we'll have even more certainty in a couple months. If those things happen the way most people think they might happen, I think lending will come back. Banks have been and lenders have been out of the game for 3 years, and they need to get back into their business.
Yeah.
I think there's been a lot of balance sheet cleaning up with banks, and there will be, like Laurie said, more competition to get some money out there, and which is great news for buyers and sellers and brokers. I would say the first quarter might be a little more the same, but if I could,
do you think it'll pick up after we get through or past this fiscal cliff issue?
Yeah, I mean, there's a lot of issues that are improving. I mean, there are lots of good signs in terms of, employment, housing starts, debt, job growth. I mean, there's some good things happening, and it's been very slow in coming. And I think by the time the first quarter ends, and things go the way we think they might be cleaned up a little bit, that I think the final 3 quarters of this year, I think, might be the next beginning of 2 or 3 years of a pretty good run in transaction activity and hotel performance.
Yeah.
I could be wrong, but I think we're definitely due for it, and I think the indicators suggest that that's where we're headed. I'm not going to bet my house on that, but I would say that I think a number of people were in agreement with that scenario.
Yeah, I think we'll continue. My take is also that we'll see sort of a steady increase in hotel transaction activity, and I think the volume will be up somewhat in 2013 over 2012. And I think we will continue to see, though, some distressed hotels, because there's distressed maybe only in terms of the capital structure, but also there's still some distressed in certain pocket markets and product types, some hotels that are still working through the distressed scenario and are closing. And we're selling a bank-owned hotel in Titusville, Florida, where the Kennedy Space Flight Center basically has shut down manned space flights, and that's had a big impact to that market. Plus, they kind of got overbuilt just before that happened. So there's still some distress coming out in the market, driving some sales. But more than that, I think people are ready. There's some pent-up demand, and they're ready for some regular transactions, and we're seeing that pick up a bit. Do you think average price?
Banks and servicers have extended a lot, and on some of these properties, that strategy has paid off for them, and things have stabilized, and they've caught up, and now the loans are coming to term and things. I think there'll be a natural, once financing comes, there'll be a natural inclination to have transactions happen with servicers and buyers in the market.
Yeah, from what I hear and have talked to some CMBS lenders recently, that market is also heating up. There are more lenders originating new commercial mortgage-backed securities loans. Rates are good, and they're also expecting, sort of a large number of hotels hitting debt maturities, and either they will have to refinance or sell. And for those that were either bought at peak or bought under more favorable operating statistics than they have right now, they won't be able to refinance, and they will have to sell. So I think those debt maturities that are coming up now, they will have an impact, particularly in the higher dollar markets, over $10, $20 million hotels. As the debt maturities come up, they either have to sell or refinance. There is CMBS financing available, but the underwriting is strict, and if they don't have the debt service coverage ratio or they have too much debt, that won't work. We're seeing some more equity money come into play. Some experienced hotel operators, companies, management companies have basically been successful at raising capital. Joe and Laurie, have you seen any of that going on in the market right now?
Yes, we have seen a little bit of that, where people are in a difficult situation and needing to bring on some additional partners or basically sell out their equity to somebody else to keep from losing the property altogether. We are seeing some of that.
And do you allow that with if a partner has to sell out but keeping the same loan in place? Have you had some sort of workouts like that?
We have some that we're looking at like that. If something else can be brought to the table by doing that and improve the situation, then we'll always consider whatever makes sense. We as a lender, we've been very fortunate. We haven't had to take back very many properties, and we do want to avoid that whenever possible. So if somebody can bring in an investor and add them into the group to keep things going, then we're open to that.
Yeah. Okay.
I would say there is increased buyer interest, and people are getting their equity together and syndicating some groups to do some deals. In terms of equity, really in the past 2 years, and Laurie, this may not pertain to PMC types of loans, but some of the commercial loans I've done with regular retail hotel sales is that by the time you put the PIP in there and you do the project cost, I mean, some people are really at 55, 60% loan to value, or loan to project cost, I should say, because many of these properties, even though it's not a distressed situation or a bank situation, their NOI is down enough, and there's an impending PIP by the franchisor that combines to create a situation that necessitates more equity in the deal. And I think any buyer walking into those situations or looking at those types of acquisitions should, at least for now, consider that is probably the reality for most borrowers going into an acquisition of say $5 or $7 million, where there might be a $2 million PIP or something like that.
Yeah, on your SBA 7A loans, Laurie, are you seeing many with a substantial PIP as part of the total project cost?
Yes, we are, and understanding what the brand is and what it's going to be, is important to determining how the hotel is going to do. So we want the PIP always to be included in the project cost, and so that is always included on both our conventional and SBA loans, and we're not seeing people putting in 45 or 50% equity, but sometimes they'll prefer to just put a minimal amount of equity down just on the purchase and then worry about the PIP on their own. And they do that, that's when they're going to get into more substantial equity in the long run, and possibly the uncertainty of where that money is going to come from to get it done, and if they're going to be able to get it complete.
Right. I'm sure as a lender you want to make sure they'll have the capital, or that at least that they're a very experienced operator in that case and have substantial resources that you're confident they'll be able to get the PIP done.
Correct. Yep, that is important, and we feel like it probably should be important to the buyer as well.
Yeah. Along those lines, Laurie, if I could ask a question. So many, what I consider some good operators and good owners, have gone through a couple, rough patches here. And maybe they have worked out a loan and had a loan worked out with a bank, or even defaulted or whatever. But the fact is, that's the nature of the business, and they're hotel operators. With people with a little bit of history of their sponsorships of these deals that maybe have run into trouble, if you're a lender, what advice would you give to a buyer that may own 5, 6, 7 hotels, whatever, and a couple of them had the rough patch, and then they're coming to you for a new loan? What advice would you give to people that are in that situation?
Well, it is going to impact, how the lender feels about financing you. If it happened on one hotel, and it would depend on how they resolved that, how they worked to resolve it, whether they had a personally guaranteed loan or a non-recourse loan, can make a difference, but it's going to be a negative factor from a lender's standpoint, because it indicates, maybe more of a willingness to do that in the future, and as a lender, that's something that we have to consider, that if we're making a loan to a person that might be more inclined to try to walk away and not feel as committed to their personal guarantee as we would like them to be, then it's going to be a negative.
Sure.
So,
but it isn't necessarily prevent somebody from asking for a loan, though, right?
Not necessarily, but it is going to be a negative. So it's something that they should consider when they're considering how they're going to work out a situation that they're in now, because it might impact them in the future. You know, if they're hoteliers, they're going to want to borrow money again, and you know, if something like that has happened, they're more likely to need to put more equity in the future. You know, maybe align with other partners that have a cleaner history, things like that, to improve their lender's outlook on them.
Yeah, say it's not necessarily a default, but maybe it was just kind of maybe the lender revalued the loan for them, and you know, there was no default or anything, but that situation alone, would you take that into consideration too?
You know, it really just depends on the situation. Yeah, if they haven't defaulted on the loan and they came to an agreement with another lender, you know, sometimes there's all kinds of different situations. Maybe they're
sure, you could resize the loan or do something, but that in itself, it shouldn't be necessarily you know, a strike against you when you go for a loan. I mean, it's a factor, of course, but not. That's
correct. You know, and sometimes
so
it was purchased by someone else at a discount, and then they were able to refinance at a discount as a result of that. That shouldn't impact them, you know, as long as they didn't default on their loan.
Mm-hmm. We're seeing some hotel refinancings that are necessary, or sales that are being driven by the lenders. Particularly, there are a few lenders, I've seen in the Mid-Atlantic, who are trying to push out hotel loans from their portfolio, and they're putting pressure on the owners to refinance, in some cases offering a discounted payoff. Does that discounted payoff, if you really see it's being driven by the lender and the borrower has been paying regularly, is that an obstacle for you, Laurie?
If they have a good payment history and it's being driven by the lender, then that can be overcome. Usually, if they're discounting it, though, there might also be the lender feels like the value is impaired somewhat, or there's not a good loan to value. So it's usually at least part of the case there. So when there's a discounted payoff, it's still often not enough to get the loan to where it needs to be refinanced. As a lender, we're a little more hesitant to step into a position where another lender is willing to do that. So when we're looking at that, we would probably regardless, even if they've paid historically, we would want them to bring something else to the table, like some additional equity or maybe some additional collateral, so that we're not stepping into the same exact situation that somebody else has discounted down to get away from.
Sure, yeah. You don't want to buy into somebody else's problem. It could
still be a great thing for the borrower, even, you know, provided that they have some equity that they can put in or can get it somehow, you know, to be able to take advantage of that discount that's being offered.
Yeah, yeah. And Joe, have you seen many short sales this year, and do you expect more next year, or?
I haven't done any technical short sales. I really only did one last year. Most of the distress-related activities are in REOs and nodes. You know, it's hard to predict the volume of the deal flow there, because banks sometimes keep things close to the vest and then all of a sudden release things. So it's pretty hard to gauge a deal flow in the future. My guess is that a lot of the banks have through this year have probably gotten a lot of stuff off the books. I don't know what they have remaining on the books and how that will be disposed, but I'm going to say that the traditional, say, note buying, one-off note buying and REO activities of the past 2 years might slow down, I think, in 2013 as the economy improves and industry improves, and some of these things are eventually worked out. And there will still be, I think, some note buying opportunities and a few REOs. I just don't get the feeling it'll be at the volume that it's been happening the past 2 years. And that's just kind of anecdotal feeling. I have no real hard statistics from the banking industry on that, but that's just my feel of talking to a number of banks that I think they feel they've gotten the big problems off. Now they're working out the middle problems, and some of those may improve, and therefore there might be less opportunities for note buyers and REO buyers. That's my guess.
Yeah, we've seen a couple short sales, one which Laurie will remember that we did earlier this year, and some bank REOs. I think that will be trailing off, but there's still some in the system that's got to work through yet.
And plus, these banks have been, they've been hounded by individual buyers during these past 2 years too.
Yeah.
So,
yeah.
in terms of, even before they even go to ready to go to the market, some of these are sold, and some of that available inventory, has been picked through pretty well.
Right.
I'd say the regional banks and the commercial lenders, those types of groups. So I'm predicting less of it, only because some's been worked out and some's been sold.
We kind of touched on earlier the political, obviously the election in November, and then we have some changes in the House and the Senate coming up, and Congress has to deal with the fiscal cliff issue. I also understand that there's a possibility of Congress considering to renew the SBA 504 refinance program. That hasn't happened yet, but it's under consideration. But for right now, that has expired, or will, I guess. And if you haven't already applied, those funds are gone, to my understanding. But I'm wondering if we might talk about what changes do we think that capital gains taxes or capital gains tax increase might drive some more transactions in 2013. If capital gains tax goes up, which I happen to think it's probably going to go up, do you think people are thinking about that now, or are you just it's out of mind right now?
Well, as a broker, I don't think that's really driving any person's buy or sell selling decisions at this point. I mean, in this industry, for one thing, the past couple of years, anyone that sold may not have had a gain anyway. So, and then moving forward, I mean, with such a low interest rate environment, even if capital gains rates go to 20%, I don't think it'll change transaction activities as far as real estate investment in terms of this really low interest rates, and then the financing comes back, and your ability to execute 1031s with a lot of inventory coming on the market. If I was a hotel investor, I don't know if an increase in capital gains would be such an onerous thing for me moving into the future.
I think more so for people who have held long term and do have a substantial capital gain, it would impact them. Yeah, there's always the 1031, and particularly with interest rates being low and opportunities out there, that's always a good option, is to just roll over the gain into the next hotel and defer paying the capital gains tax.
I mean, people aren't going to wait until they go back to 15% again to sell. I mean, capital gains rates, I mean, from a national economy, really don't, in the long term, don't change transaction activity in a lot of areas, not just real estate, but in the stock market too.
Yeah. People hate to pay it, but they seem to rarely plan for, or it's true, I guess, they don't make their decisions as much centered around whether or not capital gains tax might go up and they're going to have to pay another 5%. So as we're coming to the end of the year and going to 2013, I'd like to ask each of you, Joe and Laurie, what do you kind of see as the key points or takeaways for progress of the hotel industry in capital markets, operations, and transactions for next year?
Well, I do think in the capital markets, as we've mentioned a little bit already, there are more lenders coming back into the market, and I think there will be more capital available. I think the rates will stay low for a while, so I think that will be more favorable. It's not going to be going back quickly to the 10% down days or anything like that, but there'll be capital available. The CMBS market is still going to be very selective, so there's if the deal has a story to it, if you're purchasing a distressed asset, you're going to need to have a decent amount of equity, but you're going to be still getting a good value on that property, so there will be a lot of good opportunities there for hotel investors.
Yeah, I think we've seen this year, and as it's progressed, and I think it'll continue next year, that there are more conventional loans being made on hotels, but just like CMBS, those lenders making those loans are particular. They like younger hotels performing well with strong sponsors or borrowers in place with strong guarantees, and in addition to that, more equity down. I'm thinking one transaction we just did where the borrower group was very strong, and particularly there was one partner who was a doctor who had high liquidity and excellent credit, and so they got a very exceptionally low rate, but they also put more cash down, about 30% cash down, and the seller had to hold about 5% of the sale amount in a subordinate position. So with that, they were able to get a conventional loan. I think we'll see more of that, but the SBA loans continue to be providing the bulk of the capital because most hotel buyers want to leverage as much as they can. Joe, what are your thoughts on those issues?
I mean, overall, the close nationally and even regionally, the last 4 months, like the last third of the year, really have been a soft spot in an improving type of market, even though it was a little volatile. I see 2013 is the convergence of lots of opportunities. From an operational standpoint, operating performance is improving. less hotels being built, where the supply-demand relationship in many markets is still very improving. So operational performance and the economy improves is good for hotel operators. In the performance of the hotels, of course. When it comes to the capital markets, and I think we're going to enter a few years of a low interest rate environment combined with increased availability of capital for hotel lending, albeit maybe with tighter underwriting standards in maybe a little more controlled type of environment, but it will be back, which is augurs well for everybody in the industry.
Yeah.
And of course, when all those forces start meeting, I mean, naturally transaction activity in real estate and the hotels will accelerate as these positive things merge together. Well, when and how long this will happen and continue, I can't really say, but I think after the past 3 years, I think we're going to approach that stretch in the cycle, that upswing in the cycle, which should be a good sustainable upswing because of lack of supply going into many markets.
Yeah. Yeah, I think it may be even 2014 and 2015 before we really start sort of people relax a little bit more and take a sigh of relief and feel like, okay, things are going well again. But it is slow improvement. And one point you touched on, Joe, we hadn't talked about new construction and capital for new construction. Yeah, I think that's going to continue to remain available only to the best of borrowers and scenarios. Laurie, would you agree with that as far as capital for new construction is going to continue to restrict the new build volume?
Yes, I would agree with that. In the both in the smaller limited service size hotels that we loan on, as well as in the larger hotels. It's very difficult to get construction financing now. I think that will continue, and that will help the operating performance improve more over the next few years with that restriction in supply.
Yeah. Of course, if you're in a smaller market and there's one new hotel built, it can have a big impact. But overall, nationally and in larger markets, I think existing hotels will benefit from a lack of new construction for the most part. We're seeing some people are really scrambling to build hotels in some of the markets we mentioned before, where the natural gas exploration is booming, and of course up in Montana, North Dakota, in those areas where the oil production is, where they're drilling for oil successfully. They can't seem to build the hotels fast enough.
But the thing is, I've looked at a few deals in Western Pennsylvania where the market is just going crazy, and it's running 85% and just high RevPAR, 20% growth the past couple of years, and we have these experienced builders. Maybe they aren't hotel owners, but they're experienced builders that they're getting. They got the brand. They got a great brand. They have some state grant money for. In economic development, and they have the equity, and I think they have good sponsorship, and still they have trouble getting construction loans. It's amazing that even on some of these markets where we kind of think that they're magic markets now, and still lenders are hesitant to jump into that.
You think it's because the lenders are thinking long term, and suppose 3 years, 5 years from now, they basically the gas runs out, or they turn it off, or something new changes, and all of a sudden the market, takes a huge drop.
Yeah, because really when you start building these, even though if it's a nice Hampton in a town of 5,000 people in western Pennsylvania, if the gas wasn't there, nobody would even think of building, something like that.
Yeah.
So I think they kind of look at it, even though it's a very real economic impact to the region, and I would think fairly long lasting. People are hesitant to bet their money on it, especially in these tertiary types of markets, where if that did go away, it would be an issue.
Yeah, and lenders did take losses on some new construction. I just spoke to a lender last week who had some hotels that were newly built that are running into trouble, and the lender may have to take them back.
Mm-hmm.
So when you build on projections, you never know if those projections are going to materialize or not.
And at the same time, some of the old 40-year-old product, a 30-year-old product in these markets, in these shale markets, their value, their performance exceeds what anyone would ever pay for those things. Because their occupancy and rate, and their occupancy, the demand is so strong that if you really cap out these things, they're worth 80, 100,000 a room, and
I had one.
Nobody would look at it for 25 a room.
I have an owner right now in one of those markets who wants to sell his hotel for over 140,000 a key.
Technically they earn them, but I don't know if
on a cap rate it's great, but the price per key starts getting a little scary.
Mm-hmm. And at that point, you should build a hotel beside it.
Well, and that's what he's worried about. He doesn't want me to talk to anybody that would do that.
Well, you just gave everybody the idea. So.
Yeah, right. Well, the trick is figuring out where. So, any last wrap-up points, or you guys want to mention?
Other than I wish everybody a very happy holiday and a great new year, and I'm as a member of HBI, it's another good year for HBI, and we thank Charlie for his leadership in the year. And at Optimum Hotel Brokerage, we're always looking forward to a optimistic new year for hotel.
Thanks, Joe. Yeah, I'm optimistic. I think next year will be a good win for almost everybody in the hotel industry. So I think that's good. And Laurie, you're optimistic for PMC?
Yes, we're looking forward to increasing our loan volume and looking forward to a good year for everyone, and appreciate our ability to work with HBI.
Great. Thanks, Laurie, and thanks, Joe. Laurie Ivy of PMC Commercial Trust, Joe McCann of Optimum Hotel Brokerage and Hotel Brokers International. I'd like to say don't forget to rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. And you can download a PDF list of today's featured hotel listings. We've had, while we've been talking about the hotel industry for next year, we've got immediate hotel offerings on HBIHotels.com, and those offerings have been scrolling by. So you can download a PDF list of those today's featured hotel listings, plus a selection of additional hotel investment assets listed by HBI brokers under the Attachments button on the top of the webcast player. As a reminder, this and previous Hotel Investor Marketplace webcasts are available for on-demand viewing anytime. 2 o'clock in the morning, you can't sleep, you can watch one of these online at HBIHotels.com. HBI will be exhibiting at the Vantage International Conference and Trade Show being held in Las Vegas on December 3rd to 6th. If you're attending, please stop by and visit with HBI brokers at booth number 400. HBI will also be at the Alice Conference. See us there. I'll be there, and Joe may be there. and probably Laurie. HBI brokers look forward to seeing you in the marketplace. And thank you all for your participation. And we wish everyone a healthy and happy and prosperous 2013. Thank you.